Yeah, they still will look at the S&P. It's still ripping. It's immortal. It's immune to any kind of force. America's still the great economy. It's still the home of the world reserve currency. And there's many things about America that are fantastic. And look at NVIDIA and look at AI and look at our technology. And, the world keeps turning and America seems to be fine. But when folks like me say, or be careful of an overvalued stock market or an overvalued bond market or a bond market on a respirator or a currency that's at risk, these aren't things I'm projecting with gloom and doom. These are things that are actually happening as we speak. The purchasing power of the dollar has just been neutered completely in my lifetime. And you can say, well, we've got an incredibly powerful stock market. I mean, look at NVIDIA, it's at 4 trillion. Microsoft, the two of these stocks alone, they combine for more than 25% of US GDP in equivalent. And it's the most optimistic and paradoxical market I've ever seen. And because it's still maintaining itself, people think that tomorrow or the next 10 years will be just like the last 10 years. And there's a really fantastic portfolio manager who's been retired now for 15 years named Jeremy Grantham at GMO, who I used to invest with. And he's been tracking bubbles throughout history, 1929, 72, 2000, the great financial crisis, even the Nikkei, of course, which was trading at 65 times earning. But the fact that he's bearish and still trading markets, or was bearish and still trading markets, didn't mean he thought the markets were sustainable. But you follow the signals, you follow the trends. But he learned some lessons which you point to. People still think tomorrow will be like yesterday, or that even today is healthy. I don't think a bubble is healthy, and I'll explain why I think we're in a bubble. But he said that man kind of tilt towards good news. It's a human nature thing. We really just want to see the good news, and the bad news is no fun at a cocktail party. And that man also has really no interest in the long term, to your point. I think bulls right now, or retail investors right now, who are being seduced by sirens toward the cliff into these markets, into ETFs and diversified equity portfolios and bond portfolios by their advisors, I think they're forgetting that these key themes in the market, Charlie McKay talked about the madness of crowds. There is a madness of crowds right now, this FOMO, this fear of missing out, this idea that NVIDIA will take us to the promised land, or that AI is immune from any real mean reversion. That's a madness of crowds. But Bob Farrell, another ignored great thinker, said that all markets mean revert. And of course, there's Benjamin Graham, who talked about the importance of value investing. But what Grantham reminded us and reminded me is that we forget the troughs in these bubbles, that all bubbles do pop. And I will argue that this is a bubble for different reasons. Again, we're led by 7 names. The Nasdaq's trading at 49 times earnings. And meanwhile, Jeff Bezos is selling 6 billion in shares. And the Buffett indicator, which is market cap to GDP, is very bearish. But the real bearish signal isn't the Buffett indicator. It's the fact that Buffett himself has hundreds of billions in cash. To me, those are neon flashing signs that the smart guys in the stock market are leaving the room. But again, people forget that there is this thing called mean reversion. And we've gotten kind of used to every market dip as an opportunity to buy because of the moral hazard of having a central bank consistently supporting those markets. But, we forget that in 1929, when we had the Great Crisis, the Great Depression, the Great Market Disaster that began in 1929, that market didn't recover until 1958. And the market in 1972 didn't recover until the mid-90s. And the tech bubble that I was very trading and active in 2000 didn't recover in 2011. And the Nikkei, which was a disastrous disaster for the Japanese equity markets, took 30 years. So I think right now there's a lot of investors in this market that are lulled into this notion that this time is different because of AI, because of technology, because of these fabulous 7. This is a new technology. I saw that same narrative during the dot-com bubble when I was a young dragon slayer in a hedge fund. And even I, as naive and stupid as I was, because I hardly knew a stock from a bond in that period, and I was just chasing IPOs, that was chasing consensus, I was chasing momentum and sentiment, and I was very, very lucky. But even I knew that this wasn't different. Railroads were certainly very important. Electricity was certainly very important. Automobiles were certainly very important. And AI and the internet are extremely important. But all of those trends that create bubbles because they're new and exciting eventually become overcrowded and overbought. I think people forget, and I was there to see it. Even Amazon in the last bubble, the dot-com bubble, lost 90%. And so I'm not saying that we're going to lose 90% in the markets, but when you see 7 stocks is concentrated, and a lot of those companies now are all investing heavy in AI, and Grantham called it like NVIDIA is literally handing out shovels during a gold rush. I mean, they're just selling these chips to all these companies. But that too can become overcrowded and overbought. But it is a bubble by every indicator. And I think investors don't have to take my word for it. Look at history. There are needles that always pop bubbles. There are any number of needles which could pop this one. It could be next month. It could be a year from now. It could be 2 years from now. But this is not, in my opinion, a time for chasing tops. To me, the most obvious needle is anything that really shocks the interest rates. If yields spike and the Fed loses control of interest rates, that would be a disaster. There's guys like Eisman, who was the movie The Big Short was based on. He said that basically even the dot-com bubble wasn't really a bubble. It was a recession. So even if we didn't have higher interest rates, maybe a recession could pop this bubble. But I'd remind Eisman that 1929 US and 1989 Nikkei, there was no recession. Those bubbles popped under the weight of their own gravity and being overbought. And any number of extraneous events that are the known and unknown could pop this bubble. And to me, the only way that this bubble wouldn't pop, literally and tragically, is if the Fed did continue to just monetize the S&P by forcing rates down, by spending mouse click money out of nowhere to sustain the bond market, to keep yields in control, and effectively monetize the market by buying every recession. But again, that can only be done by really, really crushing and debasing the dollar behind that monetization. So the only, good news, the market can be sustained. The bad news is every dollar you measure your portfolio wealth, it buys less and less. So again, the Wizard of Oz isn't going to save this. Markets do mean revert. I don't know when. Jeremy Grantham doesn't know when. Jeff Bezos and even Warren Buffett don't know when. But I think their behavior suggests they think it's coming sooner rather than later. That's not helpful. But I've often joked about if you're a turkey on a farm and the farmer's bringing you food every month, doesn't mean he doesn't have other plans for you come Thanksgiving. I don't know when Thanksgiving's coming, so to speak. But I am that turkey on the farm that's now skeptical of that farmer. And I don't know the date. And I don't know the year. I just know an overvalued bubble when I see one. And I know how bubbles behave, and I look at net income margins that are unsustainable. And it doesn't, again, mean the end of this Magnificent Seven or the end of the S&P. It just means a massive, massive revaluation. Otherwise, the only way to save it would be to effectively make the S&P and the Dow and the NASDAQ a national 401k. It's too big to fail. It's a matter of national security, so we monetize it, but nothing comes for free. That would be at the expense of the dollar. The risks are, again, as I was kind to say, we've seen examples of our freedoms, whatever we think of, for example, of COVID, whatever we thought of that, the ability to control our movements, to control our decisions, to coerce our own decisions with our own bodies. Some people could argue there was nobility behind that. Others could argue that there was something far more nefarious. Mostly that was an extreme overreach of power. And if we look back now factually, there wasn't at least an open debate from discussions that were had by very smart people who had very different views than the official view, but there wasn't even a discussion about that was censored, that was controlled. And those that did disagree, and the most famous example were the truckers in Canada who were green rolling into the Capitol, and Trudeau at the time just threatened to take away their cash or take away their crypto or anything that they could get their hands on electronically. That would be far easier to do in the distant and now near future with stable coins. Now, there may not be a crisis today. It may not be one tomorrow. There may not one be in 4 years. But if there is another crisis where the people disagree with policy overtly, it will be that much easier to neuter them financially by taking their tokenized dollars, their stable coins. And that may sound sensational and it may sound far-fetched, but many things that I thought were sensational and far-fetched pre-COVID have now become reality, which is why, again, not trying to segue into gold, that analog pet rock that I own and touch and feel myself outside of that system, outside of those banks, outside of those tokens, may not be as practical or fast or efficient, although in many ways it can be if owned correctly, but a heck of a lot more privacy and more control. It's in my control in a world that's becoming increasingly harder to find private and personal control. Again, that's not because people have things to hide, but they want to be protected from their own governments. And I think the trust in our governments, again, left or right, pick your side, is openly in decline. Even former Democrats have gone one way and former Republicans have gone the other because they're disappointed with both. And here in Europe, we have a lot of patchwork coalition governments that do not represent the majority voice, that do not fulfill the promises made during election time. And so with this distrust being palpable and obvious in so many examples, I want to have an asset that's outside of that system, that's in my control, that that isn't digital but physical. And digital may not, physical analog pet rocks held outside the banking system may not be as sexy or as speedy as tokens and the tokenization of everything and this ISO compliant technology that XRP and Ripple invented long before Bitcoin by God knows who, most with NSA fingerprints on them objectively. I'd rather have that pet rock than that modern, sexy new digital thing. Modern is not always better. There was a great quote by a French author, Saint-Exupéry, who died during World War II. And he said, it's sad that we can create a society that can manufacture 1,000 pianos a day. We just can't find any good piano players. So in other words, you can have technological modernization. You can have extraordinary new shiny things like the .com of all things, or the AI of all things, or the tokenization of all things. And they can be wonderful in a lot of ways, like a bunch of pianos, but you still have to think for yourself. You still have to be autonomous. You still have to be critical thinking. And I think you still have to protect your own rights. And these type of practices, and even AI included, are taking away some of those liberties. And gold doesn't solve all of these problems at all. But financially, if there's one area I can carve out some autonomy, I want that pet rock in analog, not digital form. And I want it outside, legally, outside the jurisdiction of a government that is not respecting my rights financially the way it promised to do when the Constitution was written and Article 1, Section 8 was written, which promised that our money would be backed by gold. We welched on that in 1971. We also made Congress in charge of our tariff policies, but we welched on that in 2025. So there's just more and more evidence that this isn't the America of Thomas Jefferson or James Madison or Thomas Paine, all flawed men, but nevertheless with great ideas that we fought over and debated over. But now we're so far from even that flawed plow that I don't recognize the policies of my country anymore.